There is a quiet machine moving through the market right now, and most people do not see it because they are looking at the wrong thing. They are looking at the headlines. They are looking at the biggest stocks. They are looking at the index and asking whether the market is up or down today, but that is not where the most important thing is happening. The important thing is that money is rotating. It is leaving parts of the market that everybody talks about, and it is moving into areas that most retail investors have never studied carefully. That is usually how important opportunities are born. They do not arrive with a loud announcement. They begin quietly before the crowd has the language to describe what is happening. If you miss this rotation, you may spend the next 12 months watching the major index move sideways, wondering why your portfolio feels stuck while a smaller group of stocks move strongly because the capital is flowing there. If you understand it, you do not have to gamble on meme stocks. You do not have to guess which story will go viral next. You simply need to understand the machine, the incentives inside the machine, and the direction in which large pools of capital are moving. That is the whole game. The market is not one thing. It is a system made of many parts. Capital moves between those parts depending on liquidity, inflation, interest rates, government spending, geopolitical risk, energy demand, technological change, and investor psychology. When those forces change, the winners change. Most people are trained to think about stocks first, that is backward. I think about the environment first. Then I think about the sectors that benefit from that environment. Only after that do I think about the individual companies inside those sectors. This is a very important distinction because a good company in the wrong sector at the wrong time can do very little for you, and an average company in a sector receiving large flows of money can sometimes move much more than people expect. So before talking about any stock, I want to start with the bigger machine. Think about the economy the way you think about weather. You do not need to predict the weather perfectly to make a good decision. You need to look outside and dress for the conditions that actually exist. If it is raining, you do not argue with the sky. You bring an umbrella. If it is cold, you do not pretend it is summer. You put on a coat. Investing works the same way. You do not need to forecast every central bank meeting, every oil price movement, every political event, every earnings report, and every market reaction. That is impossible. The right question is simpler. What is the weather right now? Right now, the weather is not the weather of 2021. In 2021, liquidity was everywhere. Money was cheap. Speculation was easy. Almost anything could go up because the tide was lifting almost everything. In that kind of environment, many people confuse being carried by liquidity with being skilled. That is a dangerous mistake. Now, the environment is different. Inflation is still a concern. Rates may not fall as quickly as investors want. Governments are still spending. Central banks are still trying to balance growth, debt, inflation, and financial stability. Geopolitical risk is high. Energy is no longer something investors can ignore. Supply chains, critical minerals, defense spending, AI power demand, and national security have all become connected in ways that many people still do not understand. This is not a simple market where you can buy anything and assume time will solve all problems. In this kind of world, what you own matters more than when you own it. Timing still matters, but ownership matters more because different sectors react differently to the same weather. Some sectors suffer when inflation stays sticky, some benefit, some sectors get hurt when governments spend more. Some receive the money, some sectors need low rates to survive, some sectors are driven by scarcity, security, and physical demand. That is why a market can look boring on the surface while certain sectors are already moving. This is where most retail investors get trapped. They look at the index, they look at the same mega cap stocks everyone else is looking at. They ask, what is the market doing? But the better question is, where is the money going? Those are very different questions to understand why. You first have to understand how the index itself works. The S&P 500 sounds diversified because it contains 500 companies. But the way it is built means that it is not equally exposed to all 500. It is market cap weighted. That means the bigger a company becomes, the more weight it has in the index. When more money flows into index funds, more money automatically goes into the largest companies. That creates a flywheel. The biggest companies receive the most automatic buying. The automatic buying helps support the biggest companies. Their market caps remain large. Then the next dollar that flows into the index buys more of them again. It is not a conspiracy. It is just the structure of the system. But if you do not understand the structure, you will misunderstand what you own. When you buy a broad index fund, you may think you are buying the whole market evenly. You are not. You are buying a lot of exposure to the largest companies because that is how the system is designed. And when the largest companies are leading, that can feel wonderful. You own the big winners. You feel diversified. You feel safe. The index goes up. The portfolio looks smart, but concentration cuts both ways. If the biggest companies stop leading, the index can struggle even while many smaller parts of the market are moving beneath the surface. You can be sitting inside the index thinking you are safely diversified. While most of your return depends on a small number of giants continuing to do well, that does not mean index investing is bad. It means you must understand what it is. It means you must understand the risk of concentration. It means you must understand that passive flows can create powerful trends, but they can also create crowded exposure. Today, the largest companies make up a very large share of the index. When 10 companies represent a huge portion of the whole market, the question becomes obvious. Are you really diversified, or are you mainly exposed to the same trade everyone else owns? That question matters because sophisticated investors understand when trades become crowded. They do not simply sit in the same exposure forever. They watch flows, they watch valuation, they watch positioning. They watch what is loved and what is neglected, and when the environment changes, they rotate. That rotation is what most people miss. They wake up in the morning, check the financial news, look at the S&P 500, glance at Microsoft, Amazon, Nvidia, Apple, and the other household names, and then ask what is moving today. But educated money is often already looking somewhere else. It moves from crowded trades to uncrowded trades. It moves from expensive areas to cheaper areas. It moves from sectors that have already received capital to sectors that are just starting to receive it. It moves from yesterday's winners to tomorrow's beneficiaries of the new environment. That is why mainstream coverage often feels late. By the time the story is obvious, much of the move may already have happened. The better approach is not to guess. It is to follow a process. The process is simple, but most people do it in the wrong order. First, understand the macro weather. Second, identify the sectors receiving money. Third, select the leaders inside those sectors. Notice what I did not say. I did not say start with the stock. I did not say start with the ticker. I did not say start with a hot idea from social media. I did not say start with a chart someone posts online. Start with the environment, then move to the sectors, then move to the companies. That order matters. If you start with stocks, you are vulnerable to stories. Every stock has a story. Every chart can be made to look interesting. Every company has someone who can explain why it will be the next big thing. Stories are endless, and most of them are not useful unless they are connected to flows, incentives, and the larger environment. But if you start with the environment, you ask better questions. Where is the world short? Where is demand rising? Where is government policy supporting spending? Where is geopolitical risk forcing investment? Where is inflation changing behavior? Where are institutions moving because they need exposure? Where is the crowd still absent? Those questions are more useful. Right now, when I look at the environment, I see two areas where money is moving in a way investors should understand. The first is energy infrastructure, especially the picks and shovel side of oil and gas. The second is critical minerals and related materials because the world's energy, AI, defense, and electrification needs all depend on physical inputs that cannot be printed. Let me start with the first one. In every gold rush, the people who get rich are not always the people digging for gold. Often it is the people selling the tools, building the infrastructure, providing the equipment, and servicing the system that principle repeats across history. Because human behavior repeats, people rush toward the visible prize, while the more durable money is often made by those supplying what the rush requires. Energy is similar. Most investors think about oil and gas producers. They think about the companies that drill, extract, and sell the commodity. That is one part of the system, but there is another part. The machinery, the equipment, the compressors, the drilling tools, the pipeline support, the offshore systems, the LNG terminals, the maintenance, the infrastructure that allows the whole system to function. That is the picks and shovels side of energy. And when the world needs more energy, when infrastructure has to be expanded, when old systems need repair, and when geopolitical risk forces countries to secure supply, the companies that provide the tools can become very important. This is not just about oil prices going up or down tomorrow. It is about a structural pressure. AI needs enormous amounts of energy. Data centers need power. Electrification needs power. Countries need reliable supply. LNG demand is growing because natural gas can move globally when the infrastructure exists. Pipelines, terminals, storage, export facilities, and service equipment all become part of the same chain. When there is tension in key shipping routes and energy choke points, the reaction is predictable. Countries and companies become more concerned with security. They want more storage, they want more domestic capacity, they want more redundancy, they want more infrastructure that creates demand for the companies that build and support the system. This is why I pay attention to energy service and machinery names. Not because I want a random oil trade, not because I want to predict tomorrow's crude price, because the broader system is telling me that physical energy infrastructure matters. Again, one company in that area is Baker Hughes, ticker BKR. I look at it as a picks and shovels company for oil and gas. It is one of the major oil field services companies in the world, and it sits in the part of the system that benefits when energy infrastructure spending increases. If LNG terminals are built, if drilling activity improves, if offshore infrastructure expands, if energy security becomes a greater priority. Companies like this are in the flow of that spending. That does not mean you simply buy it blindly. A stock is not an idea. A stock is a combination of fundamentals, flows, timing, risk, and price behavior. The way I think about these names is not, do I like the story? The way I think about them is the money confirming the story? That is where price behavior matters, often before a stock moves significantly. It spends time moving sideways. It builds a base. Buyers and sellers argue with each other. The stock goes up to a certain area, pulls back, comes back again, fails again, and repeats that process. Most people become bored during that period, but markets often reward patience. When a stock has gone sideways for a while and then breaks above the prior highs with strong volume, it can signal that demand is finally overcoming supply. That does not guarantee success. Nothing does. But it can improve the probability that money is moving in. This is one reason institutional investors are often willing to pay a little more after confirmation. Retail investors often want to buy something because it is lower. Professionals often want to buy when the market proves that buyers are in control. That can feel backward if you were taught that buying cheaper is always better. But investing is not only about price, it is about probability, risk, and evidence. A stock that is cheap can get cheaper if no money is coming in. A stock that looks expensive can keep rising if large capital is accumulating it. The key is not to overpay blindly. The key is to define what confirmation looks like, define your risk, and act only when the conditions match the plan. Another name in the same broad energy infrastructure area is NPK. It is smaller and more specialized. It provides temporary worksite infrastructure for energy and construction projects. That kind of business can benefit when physical projects expand, when energy activity increases, and when infrastructure demand strengthens. The interesting thing about a smaller company like that is that it can move significantly when the money starts paying attention. But smaller companies also carry more risk. That is why the position size and the entry discipline matter. Again, I am not looking at these names as stock tips. Stock tips are dangerous because they make people focus on the object without understanding the system. The point is to understand the process. First the weather, then the sector, then the leaders, then the chart, then the risk. When I look at a chart, I am looking for a heartbeat pattern. I want to see where the highs are. I want to see where the lows are. I want to see whether the stock is quietly compressing. I want to see whether the lows are rising, whether sellers are losing power, and whether a breakout above the prior highs would indicate that buyers are finally taking control. I am not trying to be clever. I am trying to be systematic. That is very different. A systematic investor says, here is the environment, here is the sector, here is the company, here is the level that would confirm demand, here is the amount I am willing to lose if I am wrong. An unsystematic investor says, I like the story, I hope it goes up. Those two approaches produce very different results over time. The second sector I am watching is critical minerals and related materials. This sounds less exciting to many people because it is not a consumer app, not an AI software story, and not something people discuss at dinner, but that is precisely why it can matter. Many of the most important parts of the economy are not glamorous. They are physical. They are difficult. They require capital, permits, logistics, supply chains, and time. The world wants more electric vehicles. It wants more batteries. It wants more solar and wind. It wants more grid modernization. It wants more data centers. It wants more defense capability. It wants more energy security. All of those things require minerals, metals, and materials. You cannot build the physical future with slogans. You need inputs. Lithium, uranium, rare earths, and other critical materials become important because they sit underneath the things investors like to talk about. People talk about AI. They often forget power. People talk about electric vehicles. They often forget batteries and minerals. People talk about renewable energy. They often forget storage, transmission, and grid materials. People talk about national security. They often forget supply chains. That is why critical minerals matter. This is not just private demand. It is also government demand. Countries do not want to depend on adversaries or unstable supply chains for essential materials. When governments decide that a supply chain is strategic, capital starts moving differently. That does not mean every mineral stock is good. Many are terrible. Mining is hard. Costs matter. Permits matter. Commodity prices matter. Balance sheets matter. Political risk matters. Timing matters. But as a sector, the logic is clear. The world is becoming more electricity intensive, more energy insecure, more geopolitically fragmented, and more dependent on physical inputs. That creates an important opportunity for those who can identify where the money is actually flowing. One company in this area is SQM, Sociedad Q, Fábrica y Minera de Chile. It is one of the major lithium producers in the world. Lithium matters because battery demand matters. Battery demand matters because electrification, vehicles, storage, and grid systems matter. The company also has operations and partnerships tied to expanding capacity. Again, the idea alone is not enough. The chart has to confirm that buyers are coming in. When I look at a name like SQM, I am not simply saying lithium will matter, therefore buy the stock. That is too simple. I want to see whether the stock has spent time building a base. I want to see whether the prior highs are clear. I want to see whether it can move above those highs in a way that shows demand. If the previous high is around a certain level, I may prefer to buy slightly above that level rather than below it because the move through that level provides evidence. Many people think this is crazy. They say, why would you want to pay more? Because the goal is not to get the lowest possible price. The goal is to make a decision with better evidence. If a stock is below the breakout level, sellers may still be in control. If it moves above that level with strength, the probability structure may have changed. That does not guarantee a profit. It never does. But over many decisions, improving probability matters. That is how I think about investing, not certainty. Probabilities. Another company in this sector is Uranium Energy Corp, ticker UEC. Uranium is important because nuclear power is becoming part of the energy discussion. Again, AI data centers require enormous power, countries need reliable baseload energy, governments want domestic supply chains, and uranium sits inside that system. UEC has become notable because of production activity in the United States, including a mine in South Texas along with other operations. The important point is not simply that it has a story. The important point is that the story connects to the macro weather, energy demand, nuclear power, domestic supply, and strategic resources. But again, there is a difference between watching and buying. A stock can be interesting and still be too early. If a stock has rallied and then collapsed, I want to see whether the lows stop falling. I want to see whether the lows begin rising. I want to see whether a reversal is forming. I want to see the market prove that demand is returning. A watch list is not a buy list. That distinction is important. Most people confuse attention with action. They see a stock, they hear a story, and they feel the need to do something. But often the best decision is to watch carefully and wait for the market to create better evidence. The third company in the broader minerals and materials area is CMP. It is another play connected to minerals and materials. What matters is that it may be near a point where a breakout would become meaningful. If the stock needs to rise further before it confirms demand, then I would rather wait for that confirmation than rush, and simply because I like the theme. This is the part of investing that feels unnatural to many people. Waiting, people want action, they want certainty, they want a guru to tell them what to buy. But markets punish people who want certainty from uncertain systems. The better way is to create rules, a rule for the environment, a rule for sector selection, a rule for stock confirmation, a rule for position size, a rule for exit, a rule for being wrong, because being wrong is inevitable. The only question is how expensive your mistakes become. This is why position sizing matters more than most people realize. You can have a good thesis and still lose money. You can identify the right sector and still choose the wrong stock. You can choose the right stock and still enter at the wrong time. You can enter at a reasonable time and still have a macro shock hit the market. That is why no single idea should be allowed to damage your whole system. The way I think about it is simple. Define the maximum amount you are willing to lose from the portfolio on a given position before you enter for me. The risk on a position should be controlled so that a wrong decision does not create a major portfolio problem. That does not mean the position size itself is tiny. It means the risk is defined. If I know where I am wrong, I can size the trade around that point. If I do not know where I am wrong, I should not be in the trade. That is a principle. It sounds simple, but it separates professionals from gamblers. A gambler thinks about how much he can make. A disciplined investor first thinks about how much he can lose. That is how you survive long enough for the good opportunities to matter. You can also approach these sectors through individual stocks or through baskets and funds depending on your skill, time, and risk tolerance. There is nothing wrong with using broader exposure if you do not have the ability to research individual names. There is also nothing wrong with owning individual leaders if you have a system for evaluating them. The dangerous thing is not individual stocks. The dangerous thing is not ETFs. The dangerous thing is ignorance. If you do not understand what you own, why you own it, what would make you wrong, and how much you can lose, then almost any instrument can become dangerous. I prefer to scale into ideas rather than dumping a large amount of money into something I do not fully understand. Scaling allows you to test the thesis, observe the behavior, and adjust as the evidence develops. Markets are dynamic. Your process should be dynamic too. Think of the stock market as a chessboard. On one square you may have software, on another square you may have semiconductors, on another square you may have oil and gas services, on another square you may have uranium, on another square you may have gold miners, on another square you may have insurance, on another square you may have healthcare, on another square you may have construction. The money does not disappear just because the index is flat. It moves. It moves from one square to another. When money leaves one area, that area may weaken. When money enters another area, that area may strengthen. The news will often summarize the whole market with one number. The SP was up, the NASDAQ was down, the Dow was flat. That kind of summary can be useful for a headline, but it is not how capital actually behaves. Capital is always choosing. It chooses growth or value. It chooses safety or risk. It chooses liquidity or scarcity. It chooses popular or neglected. It chooses domestic security or global efficiency. It chooses physical assets or financial assets. It chooses the areas where the balance of risk and reward appears more attractive. Your job is to observe those choices. That is why I come back to the phrase follow the money. It sounds simple because it is simple, but simple does not mean easy. It requires discipline to ignore noise. It requires humility to admit you do not know the future. It requires patience to wait for confirmation. It requires risk control to survive mistakes. It requires enough curiosity to look where other people are not looking. Most investors do the opposite. They follow attention, they follow excitement, they follow yesterday's winners. They follow whatever is already obvious that can work for a while, especially when liquidity is easy. But when the environment changes, the old playbook stops working. The crowd keeps looking at the same names while the money begins to move somewhere else. That is how people get left behind. They do not lose because they are unintelligent. They lose because their map is old. The map from 2021 does not work perfectly in a world of higher rates, sticky inflation, geopolitical risk, energy pressure, AI power demand, and supply chain fragmentation. A different environment needs a different map. That map does not require you to predict everything. It requires you to understand cause and effect. If AI requires more electricity, then energy infrastructure matters. If energy infrastructure matters, then the companies supplying equipment, services, and systems may receive capital. If governments worry about energy security, then domestic supply chains and strategic infrastructure matter. If electrification expands, then minerals and battery inputs matter. If countries do not want dependence on foreign mineral supply, then domestic and allied supply chains matter. If all of that is happening while many investors are still focused on a narrow group of mega-cap stocks, then the rotation can create opportunities outside the obvious trade. That is the logic. You do not need to make it more complicated than that, but you do need to respect risk. There is no such thing as a risk. Free opportunity energy stocks can fall. Mineral stocks can be volatile commodity, linked businesses can move sharply, smaller companies can disappoint, government policy can change, breakouts can fail, institutions can reverse direction, the world can surprise you. That is why the process matters more than any one name. BKR may be interesting because energy infrastructure matters. NPK may be interesting because worksite infrastructure connects to energy and construction activity. SQM may be interesting because lithium connects to batteries and electrification. UEC may be interesting because uranium connects to nuclear power, AI energy needs, and domestic supply. CMP may be interesting because minerals and materials connect to the same physical economy, but no ticker is the real lesson. The lesson is the sequence. Look at the weather. Find the sector receiving money. Identify the strongest names. Wait for confirmation. Control the risk. Scale intelligently. Leave when the evidence changes. This is how you avoid being trapped by a market that looks simple on the surface but is complex underneath. The largest stocks can keep getting larger because the index structure pushes money toward them. That is one machine. But sector rotation is another machine. Both machines can operate at the same time. You can have passive money supporting mega cap concentration while active money quietly rotates into physical economy sectors. If you only watch one machine, you will miss the other. And that is what is happening to many people. They think the market is only about the biggest technology names. They think if those names stop moving, there is nothing to do. They think a flat index means a flat opportunity set. That is not true. A flat index can hide violent movement underneath the surface. Some sectors can fall apart while others break out. Some stocks can stagnate while others receive new institutional sponsorship. Some investors can feel trapped while others are simply positioned in the areas where the money is going. This is why I do not think in terms of one market, I think in terms of systems within systems. The economy is a system, the market is a system, each sector is a system, each company is part of a system. Capital flows through all of it based on incentives and constraints. When constraints change, flows change. When flows change, prices change. That is the chain. The investor who understands the chain has an advantage over the investor who only watches the price. The price is the effect. The flows are closer to the cause. The environment is deeper than both. So the question I would ask today is not, what is the hottest stock? The question is, what is the environment rewarding now that most people still are not paying enough attention to? My answer is that the environment is rewarding parts of the physical economy again. Energy infrastructure, oil and gas services, LNG build-out, critical minerals, uranium, materials, domestic supply chains, the tools and inputs that sit beneath the stories everyone else likes to talk about. That does not mean you buy everything. It means you pay attention. It means you build the watch list. It means you track the charts. It means you look for bases, breakouts, volume, and relative strength. It means you understand why a stock is moving before you risk money. It means you do the work. And the work does not need to consume your life. If a person spends 40, 50, or 60 hours a week earning money, it is not unreasonable to spend 1 hour a week understanding how that money is invested. The problem is that many people spend enormous energy making money and almost no structured energy managing it. That is not a lack of intelligence. It is a lack of process. And process can be learned. The process begins with seeing the market differently. Stop seeing it as one line on a screen. Start seeing it as a map of flows. Stop asking only whether the index is up or down. Start asking which sectors are gaining sponsorship. Stop chasing stories after they become obvious. Start identifying where capital is moving before the crowd fully understands it. Stop treating every stock as a standalone idea. Start placing each company inside a sector, each sector inside a macro environment, and each decision inside a risk management framework. That is how you move from guessing to operating with principles. My principle here is very simple. Follow the money, but never follow it blindly. Follow the money with a map. Follow the money with confirmation. Follow the money with risk control. Follow the money with the humility to know that you can be wrong. The people who survive and compound over time are not the people who are always right. Nobody is always right. The people who survive are those who make sure that being wrong does not destroy them, and that being right can still matter. That is why these rotations are important. They create opportunity, but only for the person who understands both sides of the equation. The upside is that money moving into neglected sectors can create strong price moves. The downside is that if you chase without a process, you can buy late size too large and turn a good theme into a bad outcome. So do not think of this as a list of stocks. Think of it as a way to read the current market. The old weather was liquidity. The new weather is scarcity, security, infrastructure, energy, and physical inputs. The old winners may still matter, but they may not be the only place where capital moves. The index may still be useful, but it may not show you the whole truth. The headlines may still be loud, but the quieter rotation may be more important. That is the part most people miss. They think opportunity arrives when everyone is talking about it. In reality, the best opportunities often begin when only the flows are talking. You have to learn how to listen to them when money leaves the crowded areas and moves into energy services. That is information. When money begins accumulating in critical minerals, that is information. When governments support domestic supply chains, that is information. When AI increases the demand for power, that is information. When a stock builds a base and then breaks above prior highs with volume, that is information. None of those things alone is enough together. They create a picture. That picture says the market is changing beneath the surface. And in a changing market, the investor who keeps using the old map is at risk. The investor who updates the map has a chance, not a guarantee. A chance that is all investing ever gives you. The way to use that chance responsibly is to stay principled. Understand the weather, rank the sectors, select the leaders, wait for confirmation, size the risk, review the evidence. Change your mind when the evidence changes. That is how I would approach this market. Not with excitement, not with fear, not with a prediction that any one stock must go up, but with a clear recognition that capital is moving and that the people who understand the movement before the crowd may have an advantage. In markets, the rich often get richer not because they are luckier, but because they understand the machines that move money. Index concentration is one machine. Sector rotation is another. Risk management is the machine that keeps you alive long enough to benefit from the other two. If you understand those three things, you will see the market differently from most people, and once you see it differently, you can act differently. That is the real opportunity. Not just BKR, not just NPK, not just SQM, not just UEC, not just CMP. The opportunity is learning how to follow the money without becoming careless, how to recognize the sector before the crowd crowds into it, and how to control risk so that one mistake does not erase the benefit of several good decisions. That is what I would focus on now. Because the next phase of the market may not reward the person who simply owns what worked before. It may reward the person who understands where the money is going next.